Hey everyone, Jeff Dorman, Chief Investment Officer of ARCA, back again with another edition of That's Our Two Satoshis Live, joined with one of our frequent guests, Research Associate Nick Coates. How you doing today, pal?
Hey Jeff, I'm good. Finals week here in New Haven.
Oh, nice.
Yeah.
I hope you're able to stay heads down then and don't have to look at what's happening in the market today.
Well, I can't. All the undergrads are walking around looking stressed out. They can't tell if they're crypto investors or not.
Well, it doesn't really matter what you're invested in right now; you'd be stressed out. So
Yeah.
there's no gains to be had anywhere. So let's talk about that. In fact, the first thing I wrote in That's Our Two Satoshis, which again for anyone watching today, you can go onto our website at ar.ca, go to our blog, and you can read the weekly That's Our Two Satoshis. But this week we started talking about just the fact that there's no relief in sight, right? I mean, I go back to, to Fed Chairman Bernanke back in 2008, right? For those who don't know, I mean, he was a student of the Great Depression. In fact, he wrote his dissertation or his thesis on the Great Depression and how it could have been thwarted by throwing money at the problem and defending against it. And of course, in 2008, that's exactly what he did. He threw money at the problem and staved off a depression. I don't think any of us thought at the time that 13, 14 years later, not only would all of these tools still be implemented, but that we would have doubled and tripled and quadrupled down through the Powell era. So I think the real question for me is, we're now heading again towards a global depression, right? We have basically sentiment in the worst shape. Sentiment in the worst shape we've seen in, probably a decade plus. And you basically have the Fed saying that we are going to fight inflation at all costs. So the question is, did we stave off a depression was that moot because we're basically just going to do it again 13 years later? Or are there any tools at the Fed's disposal or other central banks right now to stave some of this off or fend some of this off? What do you think, Nick?
Yeah, I mean, it's really a story, I think, of kind of, as you highlighted a bit later on, like the long-term secular forces that are at play. And you can have these cycles over time, business cycles where monetary agents and the government can stimulate the economy. But overall, you're talking about if population growth is slowing and productivity growth is slowing, you're kind of trending lower and lower while you're cycling. So, once you start getting towards that lower bound of where growth is getting to zero, you dip down and you're close to a pretty bad recession at that point. They certainly have tools in the tool belt. The government can come in and certainly stimulate more. There's more that can happen. I just don't know if this is the time where they're wanting to do that given the inflation conditions.
Yeah, I agree with that. And I think, one of the things that's important is the Fed can only do so much, right? We talk about don't fight the Fed. Obviously, you certainly want to be on the right side of what they're doing. But in terms of real inflation, there's only so much you can do by raising interest rates, especially when the market has already priced that in for you, right? The 2-year coming in at a 260 or 270 when the Fed funds rate was only down at 75 bips. You got a long way to go just to get back to where the market's telling you it should have been anyway, right? So with the Fed behind the curve, a lot of this is symbolic, right? The Fed's job is to make sure inflation doesn't get worse. And the real risk of inflation is when, you get your paycheck and you go spend it immediately because you're worried about it being worth less a week later or 2 weeks later. So everything the Fed is doing from the jawboning constantly is basically to say, we have it under control, everything's fine, we're going to be aggressive, we're going to fight this. But really all they're trying to do is calm consumers down so they don't make inflation worse by spending every dollar they have because they think their money is going to be worthless. And they're basically just buying time for natural deflationary forces to take over. And we'll get a glimpse of that on Wednesday with the CPI number. Last month was 8.5% year over year, but the comps are getting tougher. So if you go back to April and May and June of last year, that's when inflation started to slowly tick up from the 1 to 2% we'd had for a decade up to 3.2% in April, I believe it was, and 4.5% in May. So we're going to start to get a little tougher year-over-year comps. So if you get a little bit lower reading on CPI, from 8.5% down to maybe sub 8%, I think that is what the market is looking for right now for a little relief. Is that some of these deflationary forces, like the wealth effect from negative price action in equities and bonds and digital assets, to what we're seeing in things like the used car index rolling over, and some energy prices rolling over. If some of these deflationary forces start to take over, then the CPI number starts to go down and the Fed can take their foot off the gas. And I think that's really all the market's looking for. What I think is potentially more interesting, though, is as I said, sentiment is so bad right now. And if you look at anybody who's likes to be contrarian, CNBC came out with their latest report talking about markets in turmoil, and shout out to Charlie Bolello, who tweeted that every time CNBC has come out with a special report about markets in turmoil, the market is way higher a year later. I mean, it's literally a perfect track record with a 40% average return in the stock market every time they like to stoke fears about the market going down. And similarly, if you look at every time the VIX has gotten above 35, the average 1 year return post the VIX being 35 or more is 20%. So if you're a contrarian, there's real reasons to believe that we're at peak fear right now, and probably a good time to buy across all risk assets, especially with tons of cash sitting on the sidelines. One of the things we like to look at is the stablecoin supply ratio here in digital asset land, which shows the percentage of stablecoins relative to the percentage of relative to the market cap of Bitcoin. So right now we're at the highest percentage ever, meaning there's more cash or stable coins in the system ever relative to Bitcoin. So long story short is you're probably going to get a relief rally at some point, especially if the CPI number is not a disaster, because there is cash out there. There is, peak fear. But it's hard to tell, right? We are in a new regime. So, Nick, anything to add to that? What in terms of macro forces or the Fed or CPI?
Yeah, I mean, I think I agree with you on the case for kind of a short-term bounce. Sentiment does seem just really overdone right now. I mean, you had Powell coming out at the last meeting and being relatively clear that they weren't planning to hike 75 basis points at the next meeting. And now the market's pricing in, a pretty good chance of that happening despite kind of explicit statements to the contrary. So the market is really, really negatively, has negative sentiment right now that might be a bit overdone. You're seeing some of that extend to crypto land as well, with some things trading below book value of their assets, things like that. So there's some evidence, I'd say, of people throwing the baby out with the bathwater a little bit, at least in the short term.
Yeah, absolutely. Okay, so let's get into the crux of what you wrote about this week. And again, for those who want to follow along or read it, I highly recommend you reading it. But we titled this week's piece, Apes and Bots Brought L1 Blockchains to Their Knees, and specifically talking about what happened with Bored Apes with regard to the high Ethereum fees that basically price everybody out of the market, as well as Solana going down again for other reasons. So Nick, why don't you walk through what prompted you to write this and what you think the solution is in terms of blockchain scaling solutions?
Yeah, definitely. So I've been, doing a lot of research recently and thinking about what the results of the wave of new blockchains that we got in 2021, how their solution and approach to scalability worked, and whether it's kind of a sustainable long-term solution. So just to back up a bit, we had previously, a lot of people thought that Ethereum might be able to be the only blockchain, right? There wasn't sufficient demand, fees were low enough. And so the block space on Ethereum didn't really cost all that much up until you got to the 2020 DeFi summer, 2021 NFT mania. And then it was pretty clear by that point, when people were paying $10, $20, getting up to $50, $100 for Ethereum fees, that there was a lot of other demand for that block space that other chains could fill. And so you had different chains like Solana, like Polygon and Matic, they're the proof of stake chain on Polygon. You had Phantom and a whole bunch of Avalanche come on board and offer this service at cheaper fees. And they did it kind of on this scale of what they're kind of positioned their native asset to be. Ethereum has always been this kind of store of value asset. We're going to charge high fees and guarantee strong economic security to our users. But the flip side of that is, when you have episodes like this Bored Ape Yacht Club mint, you can price everyone out because there's just too much demand relative to supply. And so the cost of gas goes through the roof. And so that's effectively what you had happen last week. Was for hours at a time, you were seeing gas fees of $3,000 to $6,000 for a single transaction on Ethereum. And so you're essentially making the chain a plutarchy. Like, there's only the very wealthiest can transact on the chain. On the flip side of that, you have a Solana who isn't as focused on making their coin a store of value. They're really just trying to be this global payments network and force everything through one blockchain. And that was a really, really successful way to do things in 2021. I mean, the coin obviously did multiples, 1,000x or something. They talk about being able to do 50,000 transactions per second. I'm pretty skeptical of that, but it's certainly very fast and very cheap. The problem with that is when it's so cheap, you can have these kind of denial of service attacks where bots are just running hundreds of thousands or millions of transactions per second on the chain because it's costless essentially for them to do that. And the validators just can't keep up. And so you effectively have the chain be taken down because there's so many people trying to do activity on it. It can't keep up, and you can't keep the consensus. And so you have with these what I would call monolithic chains where they're trying to do everything in one chain. This issue where you kind of run into either they cost too much or you are subject to these economic security attacks.
So explain that more, because I think that was really interesting when I was reading what you wrote, talking about the dual functionalities of the blockchain and which blockchains are really only tackling one part of it versus those that are trying to tackle all of it at once. Maybe you could break that down.
Sure. So the basic kind of core innovation with a blockchain is it's essentially a computer. So a computer does two things. It does execution of data. So it changes the state of what all the information it knows is. And then it provides availability for that data. So in your hard drive, you can recall old data. A blockchain does those exact same two things, but it distributes that information across a network of computers. And previously, we'd never been able to agree about what the state or what the executed transactions were across a different network. So what a blockchain does is provide consensus about what those are. What a monolithic chain does is attempt to do all three of those functions within the same blockchain. And when you have that, that leads to some of these scalability issues. In the future, and in some cases currently, we have attempts to break out those different functions. So for example, Near is a blockchain that has execution on the chain, but it breaks out how it stores the data, its data availability, into shards. And so it has these little separate parallel blockchains that it's dumping all of the data onto, and that allows it to run a lot quicker, a lot cheaper for its users. And so blockchains like Solana, Ethereum, most of the blockchains we know today are essentially monolithic, but chains like Ethereum, Avalanche, Polkadot, Cosmos, and Celestia all have these plans to become modular over time, where they break out consensus or kind of the validation point, the data availability where they're storing the data, and then the chain that they're executing on. And the core point there is that if you break those out and you have the validation be really secure, you don't have to decentralize the point where you're executing on. So you could just run the execution in one big server, kind of similar like you see the Solana network running currently. You could do that and it could run super fast, but you still have that economic security.
Right.
And the other point there is with layer twos. So if you're building a new chain on top of a chain that's determining consensus, you kind of flipped the cost mechanism. So on Ethereum, for example, today, when you have more users, the average cost per user goes up because you're filling up the blocks, and then there's too much demand for a fixed amount of supply of block space. Whereas on a layer two, you essentially have this fixed cost business where there's, say a $10,000 fixed cost and then a very small variable cost on top per the amount of users trying to fit into the block. Well, so if there's 10,000 users going in, they're each paying, 10,000 plus a little bit, or so a total of $1 per person. But if there's 1 million users trying to fit in that block that's getting submitted back to Ethereum, the average cost goes down, magnitudes. So you're inverting that cost curve where when the more users you have per block on L2, you're actually paying less per user.
Right.
With the same amount of fees going back to secure the layer one.
So what do you think? I mean, with with the emergence of these other layer ones, and obviously some of the layer twos, and all the different money and time and energy that has been put into all these different scaling solutions, now that we're starting to see some of the hiccups, right? I think what you wrote specifically was, some of these problems we're seeing today were either not thought through or were thought through, but were kind of inevitable. And now, given the demand on block space, we're starting to see them come to fruition. Like, what do you think? What do you think the major lessons learned are, and where we head from here?
Yeah, I mean, I don't think the lessons have fully permeated the industry yet. I think there's still a lot of evidence of people trying to force this kind of monolithic narrative, but I am seeing more evidence towards the shifting towards the kind of modular framework where they break these out. So any of the new chains that you see coming out these days, or at least the ones that kind of gain and market attention and some narrative, have this modular roadmap where they're at least planning, or at least have already started to make that progress towards breaking the functions out. I think that is the end game, and I think that's kind of how, I believe that's Vitalik's words, but I think that's how we eventually scale this.
So, without necessarily putting price targets or specific names, as an investor, what would you be looking for right now that would give you confidence, either in ETH or other existing layer ones or some of the layer twos? Like, what specifically are you looking for where it starts to give you confidence that some of these scaling issues are going to start going away and ultimately be solved?
Yeah, that's interesting. I mean, certainly the biggest issue here, this narrative has been around for a while. The problem is it's just been pushed out into the future over and over again. The particular name there would be Ethereum, right? Where we've had this vision of sharding and of the merge since it came out, since 2016, and that's just been continuously pushed back. So if we start to see, real progress towards the merge, where we finally do have this kind of broken up onto the beacon chain and then eventually sharding, and some of these other layer ones gain traction, I think that's one thing to look out for. Another thing is something that's starting to happen right now is layer twos on Ethereum, at least, starting to issue tokens. I think that is really, really helpful from a user bootstrapping perspective, because it's a different, doing like liquidity mining with a layer 2 token is different than doing it with a layer 1 token, because of that dynamic that I mentioned before, right? If Avalanche and Near are competing to attract total value locked by issuing a whole bunch of money of their token, and distributing incentives, it's really a neutral sum game. There's nobody who's gaining or losing from bringing the people over, because as people move to one chain, the fees go up, right? The users are paying more fees. Whereas if a layer 2 is doing the same thing, they bring users over. Now you have more users on the chain, and they're bringing fees down on average. So it's actually a positive sum game. And that's, I think, a really interesting point where you get a much more of a flywheel with these layer 2s once they issue the tokens. And in the particular of like Optimism and Arbitrum, reduce the kind of metering that they've got, where they're kind of keeping gas fees high currently.
Gotcha. Well, it was a fascinating read. I mean, obviously, I spend a lot of time working with you, every day. But even when watching you put this on paper, even though you've explained it to me and we've been discussing it as a fund for years, I really encourage people to go read it. Again, ar.ca/blog. The title of this one was "Apes and Bots Brought L1 Blockchains to Their Knees." Really fascinating look at this. And I encourage people to strike up a conversation with Nick, talk a little bit more about both the technical solutions as well as some of the investing ideas based on that. But Nick, job well done. Good luck with finals. Thanks for joining as always, and we'll do it again soon.
Appreciate it, Jeff. Have a good one.
You too, man.